has set up for us. Wow, what a month January was. The 31st, we're nearly done with it. What is February going to look like? How bumpy a ride is it going to be? Well, to discuss that, we're joined now here in London on set by Kristine Aquino, who leads Bloomberg's rates coverage in Europe, and Ira Jersey, Chief US Rate Strategist for Bloomberg Intelligence. Kristine, let me start with you. A, do you think we're done? B, do you think January is going to be as volatile? And what could be the catalysts to keep us in the kind of current environment, do you think?
Well, Guy, the answer to A is no. I think we're absolutely not done. I think we're just getting started in terms of how markets are really digesting through the big themes for 2022, which is really all about the new era of central banking and central bank policy trajectory, in addition to all of these lingering issues still related to inflation. Of course, you have the supply chain issues in relation to that, and of course, the energy crisis as well that we're still facing here in Europe. And so I think really we're just getting started. And what could really keep us in that mode of very volatile markets in January is really all about a matching of expectations between what markets think central banks are going to do and what central banks actually do, and whether there's a divergence there, both in terms of the markets versus central banks camp, and also divergences within the central banks themselves. We do know that the Fed, for instance, and the BOE are expected to hike 5 times this year.
Yep.
Exactly. They're going to be matching each other, but the ECB's quite far away in terms of expectations still of what they're going to be doing this year. But there's a lot of room for that to get repriced. We're only in February. There's a lot of months left to 2022, Guy.
Yeah, we're only in February, not even, and I don't think any of us can believe that. And Ira, over the course of January, we have continually seen a ratcheting up of expectations for how much the Fed will tighten this year. Have you had to readjust? Are you now at 4, 5, 7, like some other shops on the street are?
Certainly 5, as Bloomberg Economics has flagged as their target, is certainly possible. I still question whether or not the Fed ultimately will be able to do that, because as the Fed gets more hawkish, they're in some ways letting the market do some of the work for them. In that the curves are getting pretty flat. You now have expectations for 5 hikes, as you mentioned, and so the question is, what happens in the middle of the year as people start to price in for, and the market certainly starts to price in for, a recession next year. Will that cause the Fed to go somewhat more slowly? There's been a lot of talk about the yield curve. I even got a number of questions this morning saying, hey, is the Fed going to care about the yield curve flattening, with the 2-year versus the 10-year now at 60 basis points, right around 20 basis points is when people flag a recession. Will they care about that? And the only way for the Fed realistically to avoid more flattening of the curve is to go slower than the market is currently pricing. So one reason why I think 4 might be on the table, but that doesn't mean we're not going to price for 6 before we start to price again for 4.
In terms of what you're going to be watching out for this month, Ira, what is it? At the moment, year to date, I think we've got the 2-year up 46.8 basis points. What are you going to be looking for to continue that move? Is it Fed speak? Is it a continuing ratcheting higher of that? Is it the data? We get payrolls this Friday. What do you think the key catalysts to keep the current trajectory intact look like?
Well, I think in large part it's going to be CPI this month and other inflation indicators. So certainly the wage component of the jobs report on Friday, I think will be something that I'll be focused very keenly on. Not so much the actual number of jobs being created, but the distribution of the wage gain. So do we see service wages continue to ratchet higher? The employment cost index showed that they did actually move up pretty significantly in the 4th quarter. And in order to have sustained inflation well above 2.5% or so, you need to have wages continuing to ratchet higher, and then pricing power by companies to be able to follow. So it's really those CPI reports and kind of the various numbers that feed into sustained CPI. And we could have a very strong CPI report yet again, well over 7%, particularly with what's gone on with the move in energy prices recently. recently. So that could spook people. And that's where maybe we start to price even for 6 hikes this year. Sure. Although I still don't think they'll be realized. The market might price that before it realizes that the Fed probably can't go quite that fast.
Kristine, Ira brought up pricing power there, which leads me to margins, which leads me to corporate earnings. Have earnings lost their ability to be a stabilizing force in this market?
Well, Kaylee, I think it doesn't have the same power as it did in previous cycles. I can tell you that much, because investors are very much focused on other potentially bigger things at the moment, and primarily, how we're looking at monetary policy changes and this new era that companies will have to deal with on an individual level as well. And so, I think for them, they're definitely thinking about just the trajectory of inflation still. That's definitely been something that we're seeing as a recurring theme, whether it's in the luxury sector, LVMH, for instance, again, displaying that amazing pricing power that they have, or whether it was Apple kind of reassuring on supply chain concerns. It is still part and parcel of the corporate earnings story. And of course, that will, whatever central banks do will have such a big bearing on the trajectory of inflation and all those snowballing effects that companies will have to face this year. And so definitely something to keep an eye out for, but definitely, earnings on their own, probably not as big of a factor as, say, what the Fed will decide to do next month.